Hello and welcome to the Financial Modeling Basics. This is part of our project which will be assessed on the financial modeling using Microsoft Excel. As you are aware, we have done chapter 1, chapter 2 we skipped, chapter 3 we completed, chapter 4 we completed, chapter 5 we completed. Now we'll be talking about mergers and acquisition, valuation and modeling. The discounted cash flow valuation and the relative valuation methodologies were discussed as part of Advanced Corporate Valuation course. In this course, we'll be particularly discussing Chapter 9, Financial Modeling Basics, and then we go into understanding how to apply financial modeling to the deal structuring as part of the mergers and acquisition activities. Let's quickly recapitulate what we have done as part of Advanced Corporate Valuation course. So I'm just bringing here the Excel sheet which we prepared to do the DCF valuation, and we got the raw data from the case study which was provided to you in that. So let's quickly understand the dynamics and the mechanics behind the DCF valuation model which we discussed in the Advanced Corporate Valuation course, and then arranged it in an order which we have here, and then integrate this with the income statement, balance sheet and the cash flow statement. These three together are called as a three-statement model, and these three statement models are based on actual historical data and based on the management assumptions for the income statement and the balance sheet. We develop the working capital schedule, the depreciation schedule and debt interest schedule, and then prepare the three statement forecasts. We call it as the pro forma statements. The income statement we project until 2022, right? These are called as forecasting, okay? And balance sheet also we do. Then we do the cash flow statement. Once we have the accounting statements in place, we are ready to do the valuation of the company, or we call it as using the DCF valuation. So let's understand what we mean by DCF. We need to talk about the capital asset pricing model. While the CAPM method is an intuitively appealing method of estimating shareholder minimum required returns, empirical studies suggest that it is often a poor proxy for the actual cost of equity. Furthermore, while the risk-free rate of return is in theory free of default risk, it is still subject to reinvestment, market and inflation risks. The appropriate risk-free rate should reflect the expected holding period of the acquirer and generally is a long-term 10-year treasury bond rate if the acquirer is considered a strategic or long-term investor. The equity risk premium, which we call it as RM minus RF, that is the equity risk premium, varies with the time period selected. But numerous studies demonstrate that over longer periods of time it tends to lie between 5 and 7. In this case, if we take the equity risk premium of the historical average since 1963 until 2017 is 5.5%. The firm size premium is a proxy for the potential default risk of the firm and is based on the assumption that larger firms are less likely to default than smaller firms. You can take the estimates of the size premium based on the market value, and this is as provided by Duff and Phelps LLC. So if the market value is 21 greater than 21 billion dollars, the percentage points added to CPM estimate is 0. So that means if it is a larger firm, we don't have to add any percentage points to the premium. But in the case of a smaller the firm, or if it is less than $1 million, then we say it is 7.2 needs to be added as the premium. Okay, and in order to do the required returns, we have estimated the cost of equity. Similarly, you are going to estimate the cost of debt, the cost of preferred stock, depending on the market values. Then finally, the cost of capital, or what we call it as the WACC, weighted average cost of capital, is based on the cost of equity times the weight of equity. The weight of equity is based on the market value of equity over the total market value of the firm, plus the cost of debt, because we are going to take the post-tax debt, or this is pre-tax times 1 minus tax will give me post-tax cost of debt times the market value of debt over the total value of the firm, plus cost of preferred stock times the preferred stock weight, the market preferred stock weight over the total market value. So usually what happens is WACC estimates are subject to circular reasoning, in that it is assumed that to estimate firm value we must know WACC, and to estimate WACC we must know the market value of equity, debt and preferred stock. This contradiction may be circumvented by assuming that firms have a target debt to equity capital ratio or capital ratio, and that this ratio is issued as the weights in the calculation of WACC. All the weights should be expressed as market values, since book values represent historical values, and a firm's efforts to raise funds would be expressed in terms of current market values. Now let's discuss how to analyze risk. Now that we know how to do the required return, let's talk about analyzing risk. So when we say risk, we have two types of risk: non-systematic and systematic risk. Systematic or non-diversifiable risk reflects fluctuations in factors impacting all stocks, but to different degrees. Like say, for example, fluctuations in interest rates, or changing inflationary expectations, and major unexpected events such as terrorist attacks and oil supply disruptions, etc. According to the capital asset pricing model, investors are compensated only for systematic or diversifiable risk. So all other risk is assumed to be eliminated by the rational investor by investing in a portfolio of stock whose earnings are uncorrelated. So the measure for the non-diversifiable risk is what we call it as beta. So beta is a measure of systematic risk. Beta quantifies a stock's volatility relative to the overall market. Beta is impacted by the following factors, that is based on the degree of industry cyclicality, operating leverage. Operating leverage refers to the lift to earnings resulting from a firm's revenue exceeding its fixed costs. Once revenue exceeds a firm's fixed costs, most of the incremental revenue will contribute to pre-tax income growth. That is, operating leverage is operating leverage is the more than proportional increase in profits that is realized once revenue exceeds fixed expenses. Similarly, financial leverage refers to the lift to the shareholders' returns once a firm's cash flow exceeds its debt service requirements and other operating requirements. Once a firm generates enough cash flow to cover its debt service requirements, that is interest and principal, and has satisfied its operating cash needs, all additional cash flow is available for compensating common shareholders. Therefore, both operating and financial leverage represents the incremental boost to earnings and cash flow once a firm's fixed expenses, example depreciation and interest expense, are covered. That is, once these fixed expenses are covered, the bulk of each additional dollar in revenue will go to earnings. In other words, firms with high ratios of fixed to total cost and debt to total capital tend to display high volatility and betas. So let's talk about two categories of betas as propounded by Professor Damodaran in his book Valuation. He talks about leveraged versus unleveraged betas. Leverage betas reflect the effects of the net increase in risk on the cost of equity of increasing leverage. If the borrowed funds are not reinvested at returns equal to or greater than the weighted average cost of capital, the increased leverage will reduce the cash flow available to compensate equity investors at rates that will enable them to earn their cost of equity. Since interest and principal must be repaid before shareholders are compensated. Another important thing is the impact of leverage on the cost of equity is a net effect because a proportion of the interest paid on the debt is recovered by the firm because of the tax deductibility of interest. So interest acts as a tax shield. Estimating a firm's beta, you have two approaches. You can use the regression approach or the bottom-up approach. Beta unlevered is determined by the characteristics of the industry in which the firm competes and its degree of operating leverage. The value of beta for a levered firm is determined by the same factors and the degree of the firm's financial leverage instead of the operating leverage. So your objective as a financial analyst or a corporate valuation analyst is to estimate a beta that reflects the relationship between risk and return in the future. The bottom-up approach suggests that the firm whose future beta the analyst is estimating better reflects the risk and return relationship of the average firm in the industry, because it adjusts for financial leverage than its own historical risk-return relationship. That is, the business risk, that is cyclicality and operating leverage only, associated with the average firm in the industry. So we use a sample of firms. So we use what we call it as a forward-looking beta based on 3 steps. In step 1, the analyst selects firms which are similar in all respects except for financial leverage. In step 2, the effects of leverage are removed to make the firms comparable in all respects. And finally, in step 3, allows the estimation of the target firm's levered beta based reflecting the industry average, cyclicality and operating leverage. That is based on the unlevered beta and the firm's own degree of leverage. So let's see an example of estimating for Brocade communication systems levered beta using the bottoms up approach. So you have a step 1. We select sample of firms having similar cyclicality and operating leverage. And then in step 2 we compute the average of firms unlevered beta. Okay. And then step 3 is re-lever average unlevered beta using Brocade's debt equity ratio. Okay. And then get the ratio for the Brocade. Now talking about the valuation cash flow. Valuation cash flow represents the adjustments made to GAAP based cash flow to convert it to cash based cash flow suitable for valuation. GAAP based cash flows attempts to realign revenues and costs incurred to generate such revenues in the period in which they are incurred. Therefore, assets are depreciated over time or over their useful lives. That is the period of time in which they can be reasonably expected to generate cash flow. Cash-based cash flows reflect the period in which cash inflows and outflows actually occurred. Let me explain this by giving you an example. Assume a firm has an annual revenue of 10 million each year for the next 5 years, and that it buys a piece of equipment for $10 million in the first year, and that equipment is fully expensed in the first year. Therefore, profit is $10 million in the first year and a positive $10 million in each successive year. So that is, in the first year you have a negative 10 million, and in the later years or successive years you have a positive 10 million. To avoid this gyration in profitability and to better align costs incurred with the period in which the revenues were actually generated, assume the equipment was depreciated equally over 5 years or 2 million per year. The resulting profitability would be 8 million annually according to GAAP accounting. Based on cash based accounting, year 1, year 2, year 3, year 4, year 5, the revenues will be something as shown here. So you have revenues, and then the pre-tax profit is 0, and then you have profit is 10 million in the first year and a positive 10 million in each successful year. Whereas in the GAAP accounting, you distribute the cost of the 10 based on the depreciation policy you adopted, and then your pre-tax is 8 over the years. So the important point is, when we use the discounted cash flows or the free cash flows, we use the cash based accounting rather than GAAP or accounting's cash flow. So let me demonstrate to you the free cash flows to equity investors and the free cash flows to the firm. As you can see here, we want to calculate the free cash flow to equity investors, or we call it as FCFE. The objective is to redefine GAAP cash flows as valuation cash flows, which represent actual cash available to reward shareholders. In FCFE, only new preferred issues are considered. new common issues are not, because FCFE is cash available for current shareholders. New issues dilute current shareholders' ownership. The cash component of net working capital reflects only operating cash balances. Okay, so if we talk about FCFF, it is simply net income plus depreciation minus changes in the net working capital minus gross capital expenditures plus new preferred equity issues minus preferred dividends plus new debt issues minus principal repayments. So that means these are the free cash flows available only to the shareholders or equity shareholders. In the case of free cash flow to the firm, or we call it as the enterprise cash flow, FCFF, we want to know the cash flows available for all the shareholders, that is repay lenders, common and preferred dividends, and to the equity shareholders. That means debt holders, preferred shareholders, and equity holders. So the formula which we use is EBIT times 1 minus tax rate plus depreciation minus change in net working capital minus gross working capital expenditures. That is what we call it as CAPEX, or capital investments. So if you want to show the comparison between these two, let's see the comparison. You have free cash flow to the firm. The cash from operating activities is the same. Cash from investing activities we take and deduct it, so we have free cash flow to the firm. In the case of free cash flow to equity, we remove also the financing activities. So in the case of free cash flow to the firm, the key point here is that the distinguishing feature between the equity and enterprise cash flow is that equity cash flow includes cash provided by or used in the financing the firm's activities. Okay. Let's do some discussion questions to further understand the concepts which were presented. How does the size of the firm affects its perceived risk? Be specific. So I give you pause the video and think. Okay. Size is often considered a proxy for solvency risk, in that larger firms with more assets available to lenders are believed on an average to be able to meet their obligations through asset sales. This of course ignores the amount and maturity composition of the firm's indebtedness. Another factor that may make larger firms less likely to default is, paradoxically, the extent to which they are indebted to lenders. Lenders may be more willing to renegotiate loan terms with such firms in the hopes they will be able to recover some or all of what they are owed. So usually you might have been seeing the news stories of Indian companies being bailed out. Now let's discuss the second question. How would you estimate the beta for a publicly traded firm, for a private firm? Again, pause and think. We can say that betas may be estimated by using regression analysis where sufficient historical data is available. However, such methods are backward-looking. Forward-looking methods use the betas of comparable industry firms or firms that are in other industries which exhibit similar risk, growth, and profitability characteristics. For a private firm, comparable publicly traded firms' betas may be used because you don't have access to historical data. So that means the bottoms up approach, the step 1 and 2 and 3 should be used to estimate the beta for a publicly traded firm as well as a private firm. That way is forward looking. Explain the difference between equity and enterprise cash flow. This is very simple. The primary difference is that equity cash flows reflect cash flows provided by or used in financing the firm. Then the next question is, what is the appropriate discount rate to use with equity cash flow? Why? With enterprise cash flow? Why? So what is the appropriate discount rate for the equity? So WACC should be used to discount enterprise cash flows, since it is the minimum rate at which providers of funds to the firm expect to be compensated. The cost of equity should be used to discount equity cash flows, since it is the minimum return required by equity investors. Okay, so now we will refer to some commonly used discounted cash flow valuation methods. So you can use zero growth model, constant growth model, variable growth model. So usually these two models are not preferred. We have what we call it as two-stage model. In the first stage, maybe we may have a constant growth model, or maybe we may have a variable growth model, and then in the end we take it as a supernormal or sustainable growth rate into consideration. So these models are based on growth rate. So if you don't have the growth rate, then you can assume that there is no growth and then you can use this. But the most widely used discounted cash flow valuation method is a two-stage method, wherein the first stage we may have a variable growth rate, and in the second stage maybe we may have a constant growth based on supernormal growth or sustainable growth rate. So determining growth rates, a firm's value can be approximated by the sum of the high growth plus a stable growth period. Okay, so the stable growth rate reflects what we call it as supernormal growth rate or sustainable growth rate. Okay, then the next important aspect is choosing the correct tax rate. So should we use a marginal tax rate or an effective tax rate? So the effective rates are those a firm is actually paying after allowable deductions. Marginal tax rates are those paid on the last dollar of income earned. Keep in mind that the crucial consideration is that the effective or actual tax rate paid by the firm in recent years may be used for the high growth period. However, the marginal tax rate should always be used during the terminal period. Why? Because failure to do would imply that the firm would be able to defer taxes indefinitely. Now, the next thing which we'll be seeing is adjusting firm value for non-operating assets and liabilities. The present value of the firm's operating cash flows must be adjusted for the present value of non-operating assets and liabilities to estimate firm value. So how we are going to do this? So the present value of free cash flow to the firm is equal to present value of free cash flow to the firm including terminal value minus present value of debt plus present value of non-operating assets minus present value of non-operating liabilities. So this is very important. Otherwise what will happen is you may under or overstate the firm's value. So you need to adjust this. So let's see one example how we can adjust a firm value. So let's say a target firm has the following characteristic: an estimated enterprise value of 104 million, long-term debt whose market value is 15 million, 3 million in excess cash balances, estimated present value of current unused license of $4 million, estimated present value of future value litigation costs, 2 million common shares of. What is the value of the target firm per common share? So you are going to use the estimated enterprise value, then you are going to add the non-operating assets, that is your excess cash balance and your present value of unused licenses. Then you are going to remove your long-term debt and your potential litigation cost, the present value of future litigation costs. So once you deduct these two items, 2.5 million and 15 million, and add 3 million and 4 million, you may get what we call it as the equity value. To this value, if we divide by 2 million, we will get the firm's target value. So it will be shown in the table as below. So this is how we are going to do. So 93.5 million divided by 2 million will give me equity value per share. Okay, so in this session we talked about what is FCFF and what is FCFE, how to estimate the cost of WACC, when you are going to use WACC and when you are going to use cost of equity, which cash flow is going to be adjusted to get the equity value, and what is the role of adjusting the firm's value based on non-operating and assets and liabilities. So this is the final conclusion. So taking this understanding, let's delve into doing our case study DCF valuation model. So with this theoretical background, let's apply the background understanding to the case study DCF valuation model. Okay, now that we are in the Excel sheet, go to the DCF valuation worksheet. Let's do this. EBIT times 1 minus tax rate, that is what we call it as NOPAT. Okay, this I can call it as or I can put a comment. So this is nothing but NOPAT. Okay, so so how to get this? EBIT times 1 minus tax rate. So EBIT, we can find it in the income statement. Go to the income statement. You have EBIT. EBIT is not there. We have EBT. So if we add interest to this, it becomes EBIT, and then multiply this 1 minus tax rate. Tax rate is the assumption which we have. Okay, enter. So you will have 5315 million. Add depreciation. Depreciation, you can find it in the depreciation schedule. You can add the depreciation. So if we add this plus depreciation will give me what I call it as EBITDA, EBITA, that is earnings before interest, tax, depreciation and amortization. You can keep this bold because this is a very important matrix which we may use for comps valuation. Then less working capital investment, that is we can get from the schedule or we can get from the cash flow statement. Let's get it from the cash flow statement. Changes in working capital. Okay, and then less fixed cost investment, that is nothing but capex. This also we can get from the cash flow statement, that is investments in property and equipment, that is capital expenditure. So the free cash flow is simply equal to EBITDA minus working capital changes minus your capex. This is what was the formula which we discussed. Okay, now that we have the formula, we can simply copy for all the years. Control R. So we have the cash flows, free cash flows to the firm. Okay, so usually these are called as unlevered cash flow. Why? Because they are cash flows to the firm, and this needs to be discounted with the overall cost of capital or WACC. So in order to get the beta, so let's assume that these figures are given to you. Beta is 1.23. So remember that a beta of 1 means it's the risk of the market. The market beta is always 1. If beta is greater than 1, that means this particular business or the security which you are going to invest is slightly riskier than the market. Why? Because the beta for the market is 1. The beta of this private company in the case study, we are assuming it as 1.23, so it is 23 basis point more than the beta of the market. Risk-free rate, we are going to take, as we discussed in the theoretical background, that the long-term treasury bill we can take. So let's assume that it is 3.5%. Okay. Expected market return, we assume it to be, say, 10%. Okay. So the cost of debt we assume it to be, say, 9%. Okay. So all this needs to be calculated based on the formulas. So right now our focus is in understanding the corporate valuation. So let's say the expected terminal growth rate is say 6%. Target debt capital ratio is 50%. Okay. So post-tax cost of debt, as we said, this is pre-tax cost of debt. Since tax acts as a tax shield, interest acts as a tax shield, so therefore we are going to take post-tax cost of debt when we are computing the WACC. Remember the formula which we discussed in the PPT in the earlier slide. So now the post-tax cost of debt is simply equal to pre-tax times bracket 1 minus the tax rate. The tax rate we are having in the assumption, so we can assume that it is 0.28 because that's what was the assumption. So 0.28 is the tax. So the post-tax debt is 6.48%. Cost of equity, we use the capital asset pricing model formula which we discussed in the earlier slides. This is simply equal to RF, that is risk-free rate, plus beta times RM minus RF. RM is this minus RF. Okay. So if you want to take into account the size of the firm, that also we can do, but here we are just taking the original CAPM formula. Okay, so the cost of equity is we got based on CAPM model. So the cost of capital is simply the weighted averages of the book value. So since we have the target capital ratio here, so let's calculate the cost of debt and cost of equity. So the cost of equity times the target debt capital ratio, okay, plus cost of debt times 1 minus the target debt. Okay, so this gives me a WACC of 10.25. So now discounted finite cash flows, we use the formula. You can see the formula here, because we are going to use only for the projections. So we have the terminal year cash flows to be also computed. So for the free cash flows to the firm for each of these years, we use the NPV standard formula with the WACC as the discount. Why? Because these are unlevered cash flows, or these are called as cash flow to the firm or free cash flow to the firm, needs to be discounted by WACC. So using the discounting formula, we get the present value of the finite cash flows. Then the infinite cash flows, we can get it through the formula. What is the formula we can use? We can use the terminal year formula as the last year, that is the terminal year cash flow, okay, divided by WACC, okay, divided by WACC minus the growth rate. What is the growth rate? This is the growth rate. In some cases you may also add, say 1 plus G, the expected growth rate. So taking this into consideration, we have okay, so we need to put a multiplication here because M11 times this. Okay, so you have the terminal value of cash flows given as this. Okay, and then the number of discounting years, how many discounting years we have. So if we are assuming that we are investing at the beginning of 2018, so 1, 2, 3, 4, 5 years. So if we are assuming that we are investing at the end or in between, then we need to take a fraction of a year and then things will be different. So you need to develop a fraction of a year formula. So anyhow, we assume that they are 5 years. So the terminal value of the discounting cash flow is this. So the value of the firm is simply adding this plus this will give me the firm value. Okay, add this to get the firm value. Then I need to deduct the cash and the debt. So let's do it from the closing balance. So the closing balance of 2018, because we are talking about 2018 at the beginning. So let's see how much is my cash. So I can get this from my cash flow statement. Ending closing balance for 2018 is this. Okay, and then I need to remove debt. So debt is, you can get it from that debt schedule. Debt closing is 30,000. Okay, so you have current shares outstanding. Let's say you have 2,500 million shares. Okay, maybe you can take 25 million shares you have. Okay, so the current shares outstanding is 25 million shares. So what I do is, to get the price per share, I simply take the value of equity, divide by my shares outstanding. So I get the price per share of this private company as 64. So this is a recollection or recapitulation of the advanced corporate valuation model. Now that we have understood how to do the advanced corporate valuation model, the DCF valuation model, I think we can proceed in this chapter. The basic understanding or the primary learning objective in this chapter is to make you understand the power of the financial models. So we'll be discussing particularly how to identify the primary determinants of firm cash flows. Anyhow, you understood in the advanced corporate valuation in the previous recapitulation of the case study. That is what we call it as the step 1 of the modeling process. As part of step 2 of the modeling process, we do the projections of the annual cash flows during the planning period, usually 3 to 5 years, and then finally we make the estimation of the present value of the projected annual cash flows, including the terminal year value, and that brings to the step 3 of the modeling process. So we try to understand as per the mergers and acquisition valuation modeling, recapitulating what we have done earlier as part of the advanced corporate valuation. So now we try to focus in understanding what is the role of, in other words, the primary role of financial models. What is the role of financial models in problem solving? Financial models, as you are aware, are mathematical representations of the financial and operational characteristics of a business. We use financial modeling to determine key value drivers, evaluate investment opportunities, estimate the firm value, and do some simulations to know the impact or evaluate the risk. So the focus in this presentation is on applying modeling to firm valuation under alternative scenarios. The next important aspect which we need to understand is the model data requirements. The quality of model output dependent on reliability of data used to build the model and credibility of the assumptions underlying cash flow projections. Care should be made in understanding the source of the data, because we need to use the data which is audited and usually present directly in the company's websites in the investment or what we call it as I will show you where to get the direct source of data which you can trust, because we have seen that there are some problems with the data providers like Tadawul data or Bloomberg data. So the best part is going to the direct source to get the financial statements or the source of data which is audited by the companies. So we'll be using always the primary data source, okay, whenever it is possible. And another important thing is the financial statements which are given in the annual reports of each of the companies which are listed in Tadawul. You can go understanding them in terms of the footnotes which will provide detailed underlying discussion pertaining to each of the line items in the financial statements. The financial statements are based on generally accepted accounting principles which are governed by SOCPA. Care should be understanding that international accounting standards, particularly IFRS, is being implemented from 2017 onwards in the Saudi Arabian SOCPA. SOCPA has given a timeline for implementing IFRS. It has been started from 2017. All listed companies were asked to complete this IFRS, that is, and as approved by SOCPA, not the entire IFRS framework given by the International Financial Regulation Standards. This is what is approved by SOCPA. So SOCPA gives IFRS which is acceptable in the context of the Saudi Arabia. So we will be using those international accounting standards wherever possible, right? Try to understand that this data which we'll be getting from the annual reports, there are linkages between the financial statements. When we say linkages, we mean that each of these individual statements, that is the income statement, the balance sheet and the cash flow statement, are linked. So when we are doing a pro forma accounting financial statements, we'll be not deviating substantially from the approved SOCPA statements. Okay. So let's discuss now financial statement linkages. As you can see here, the income statement is linked by way of the net income. The net income is divided into two categories and it is reflected in the retained earnings, right? Part of it is you are going to distribute by way of dividends, but mostly is retained for further investment in the business. So this is reflected in the balance sheet under the liabilities as retained earnings. Okay, and also you find that the cash flow statement, it starts with the output of the income statement. The output of the income statement, that is the net income, is taken and then you make your cash flow statement. This cash flow statement is further linked, the ending cash balance is linked to the balance sheet. So you can find how these are linked and interlinked with each of these financial statements. So as a result, what happens is when you are making a financial model, the chances are that you may need to do what we call it as circulatory error. Like say for example, in a financial model, if you are talking about say interest expense which reduces net income, right, and then it further lower net income reduces cash available to repay debt, and this lower cash available to repay debt increases debt outstanding, and then higher debt outstanding increases interest expense, and then this completes the cycle. So when you have this circulatory thing, that is net income is dependent on net interest expense, and the interest expense is based on what we call it as interest income less interest expense, which is dependent on yearly average debt and cash balances. Outstanding debt and cash balances are dependent on cash flow. That is, a positive cash flow can be used to pay down debt or add to cash balances, while a negative cash flow would require additional borrowing. So this needs to be resolved. So how we are going to resolve the circularity of the financial model is a very crucial thing. So usually we use the Microsoft to remove the circular references. If you see this, the circular references are a series of cell references in which the last cell reference refers to the first, resulting in a closed loop. So in order to compute, you need to break this loop. Okay, so to resolve the common circular reference existing between the income statement and the balance sheet, Excel substitutes various values of the variables involved in the circular reference, such as income and cash balances, until the difference between the right and left sides of the balance sheet differ by 0.001. So what we are exactly doing is we are asking the Microsoft Excel to automatically resolve this circular references using the options that set maximum number of iterations to 100 and the maximum amount of change to 0.01, that is 100. That means it will take into consideration. So in the model which I am going to share with you, we use what we call it as the toggle buttons. So this is an alternative mean of resolving circular references by way of yes or no or on and off button. So in our model we use what we call it as 0 means circular reference is off, 1 indicates circular reference is on. So such buttons are used by switching the interest income, interest expense, or revolving credit facility. So you can toggle on and off and on, okay, by replacing 1 or 0. Now let's understand the key steps in the valuation process. Step 1 is analyze the target firm's historical financial statements to identify the primary determinants of cash flow, and then you input the historical data. Step 2 is project 3 to 5 years or more of annual pro forma financial statements. This 3 to 5 year period is called the planning period. Beyond this period, you are going to project what we call it as the terminal value. So you need to estimate the present value of the projected pro forma cash flows included with the terminal value. So let's discuss in detail what is step 1. In step 1, we analyze recent financial statements to identify value drivers or variables which have high correlation with the operating cash flows and in turn reflects the firm value. To do so, we normalize historical data by adding large non-recurring losses and subtracting one-time gains. Key value drivers include the sales growth rate and cost of sales, or what we call it as the COGS, the cost of goods sold as a percentage of sales. A simple plot of a firm's gross margin as a percent of sales over at least one full business cycle, 5 to 7 years, provides useful insight into how the firm was able to create value historically. An increase in the ratio over time indicates that the firm has been able to reduce its costs compared to sales, raise prices on each item sold, or a combination of the two. A declining ratio reflects deterioration in the firm's ability to control costs, raise prices, or both. However, gross margin, that is the difference between revenue and cost of sales, as a percent of sales, may show considerable variation from one year to the next. How we deal with this issue is addressed next. So you have sales growth and profitability, which are determined by both industry and firm specific factors. So in order to understand what governs this growth rates in the sales and the profitability, we evaluate the industry specific factors using the 5 forces model, which we have discussed in the class. The Porter's 5 forces model, that is the customers, the competitors, the potential entrants, product service substitutes, and the bargaining power of suppliers, may be applied to determine industry specific factors impacting sales and profits. And then you go to the firm specific factors, which are internal to the firm's competitive position within the industry. So let's see the Porter's model in terms of the industry specific factors and how it affects the profitability. So the characteristics of high profit versus low profit industries are associated with the 5 forces. If you have a weak suppliers, weak customers, high entry barriers, few substitutes, and little competitive rivalry, then we say high industry profits are going to be determined. But in the case of the 5 forces are strong in terms of the suppliers and strong bargaining powers of the customers, and there is low entry barriers. In other ways, any firm can enter into the business and may change the business landscape altogether. As we have seen, many technology companies comes into the industry, specific industry, and then changes altogether the business landscape in that industry. Or if you have many substitutes or intense rivalry competition. Okay, so if you have all these forces going against you, then we have what we call it as low industry profits. So under this situation, your profitability and gross margins are going to be different than if you are working for a high industry profits. So in general, highly profitable industries are subject to less competition than lower profit industries. Highly competitive industries tend to experience so-called normal profits, that is, a level of profits that compensate firms for the risk they have assumed. Less competitive industries often result in firms earning above normal profits, that is, those in excess of the risk assumed. Let's see an example of a high profit industry would be soft drinks, and a low profit industry to my knowledge would be an airlines. The terms weak and strong refer to the bargaining power of suppliers and customers relative to the firm being analyzed. So let's see now the firm specific factors and how it affects the profitability. So we have revenues which reflect a firm's pricing power, that is the ability to gain market share and the growth in product demand in the industry. So you have pricing power, unit sales growth driven by growth in the industry, or market share gains affected by new product development, or you have a clear competitive advantage, I can say. So the pricing powers, that means high pricing powers are high when barriers to entry is high, number of substitutes is low, market share relative to competitors high, affecting relative cost position when excess capacity is low, and when government regulation is low. If we talk about the determinants of unit sales, it differs industry to industry. For example, Beverage and personal care products, example shampoo, are heavily influenced by demographics such as population growth and changes in the age composition of the population. Sporting goods sales are directly related to advertising and marketing expenditures. Consumer confidence and borrowing costs. Pharmaceutical product sales are impacted by research and development spending and the aging of the population. And the demand for smartphone apps is correlated with the growth in handset sales. So these are firm specific factors and how it affects the profitability. And let's see the historical income statement. That means the model which will be provided to you for your research project. So as you can see, we have marked the target historical income statement, which you need to fill the data directly from the annual reports, not from Tadawul, not from Bloomberg, but from direct source. That is, you need to go to the financial annual reports of each of the companies which you are going to analyze. So what we'll be doing is, the cells in yellow require the input of actual historical data. So we expect 3 years data. That means you just download 2 recent annual reports, and that way you can get the 3 years data. So feed the data as given to you. I will show you in my next video how we are going to do this. Thank you for listening patiently.